We believe strongly in the resilience of our strategy and the portfolio. However, once in a while, the market and the investor sentiment challenges the current status quo and the common wisdom. We are in the midst of such a cycle since the emergence of AI is challenging the common wisdom of software company investing. In general, software businesses are very attractive businesses due to very high profit margins, supported by sticky revenues, low capex, and high growth driven by the digital transformation of the economy. However, the appeal of owning software businesses has also increased valuations to very high levels, which are now being challenged due to the emergence of AI, either lowering the profit of software businesses or taking market share from traditional software businesses. We believe that many software businesses actually will benefit from AI and can grow their market share as long as they are deterministic and have embedded deep domain expertise. However, in the past 6 years, we at ICG Enterprise Trust have been challenged by the high valuations of the sector and needed to show some caution. And I believe we have been disciplined, turning down the opportunity to invest in some very strong and excellent companies because we did not think the valuations were sustainable. Therefore, our software exposure is only 12% and significantly below the private market average of 25%. Our software exposure is typically in mission-critical companies in accounting, payroll, or compliance, which we view as resilient. BSI, for example, is a mission-critical software service for the German-speaking banking system, where data integrity and security is mission-critical. Ping, in a similar vein, is a leading cybersecurity business for large enterprises and benefits from heightened cybersecurity risk driven by AI. And lastly, we invested in Precisely, which is a data management software service critical for ensuring data integrity in AI-driven systems. And in this investment, particular Enterprise Trust benefits from the embedded downside protection of the investment. We would also note private market multiples still remain at a discount to public markets. Public market software multiples, according to the S&P Software and Services Index, reached 31 times at the start of the year, and even with the recent corrections, stands at 24 times. Meanwhile, the average multiple of Enterprise Trust software companies currently trades at about 21 times. So we believe still conservative to public markets. And finally, a defining feature of ICG investments is a focus on embedded downside protection. We assume in our direct software investments a multiple contraction to our exit investment case, thereby creating downside protection in our software investments. And furthermore, ICG invests also across the capital structure, providing further downside protection than a pure equity investment. Mark from the ICG Europe team will give real-world examples in a bit more detail later on that. So the message here is simple. Our software investments are actually a good example of our disciplined investment strategy. We've been increasingly selective, focusing on mission-critical companies, and we can invest with downside protection, which leads to a portfolio of mission-critical software companies, but significantly underweight compared to the overall private equity market average.